Good morning, everyone. My name is Frank Milone. I'm one of the founding partners of FML. We are still getting a lot of people joining into our webinar today, so we're going to just give it 5 more minutes or so to let people kind of jump in before we start. So as we're waiting for others to arrive, just to remind people to review the published comments in regards to making sure you're staying current on the slides by pushing the live button on the bottom left of the screen. There is a Q&A function within Teams Live that you can ask questions. We will do our very best to answer those questions, but we're going to try to make sure we're sticking to an hour, as we know people are very busy. So please ask your questions. If we don't get to those answers, we will do our best to get an Q&A out to all of the participants after the presentation, and we'll also get a copy of the slide deck out to all of you as well. So again, we're waiting just a couple of minutes to allow people to jump into the webinar, and we'll get going in a couple minutes. Thank you very much. Hey, Bill, just to let you know, as we're going through here, if you're answering questions, make sure you publish them on the using the button on publish, and that way they'll get viewed by everybody and not just the recipient of the private response. Hello, everyone. Again, my name is Frank Milone. We're going to give it a couple more minutes before we get going. So please bear with us, as we do have a lot of people attending the webinar today, and we want to give them enough opportunity to jump in to the Teams Live platform, as it may be a little bit newer for people. So bear with us. Again, please read the published announcements in regards to if you have questions in regards to how to keep current on the slides, and we'll get going momentarily. Once again, everyone, just be aware that we're going to be starting momentarily. We have a number of people still joining the webinar. We just want to give it 2 more minutes for people to get settled in. Appreciate your patience. We do have a lot of people anticipated on the webinar. We just want to give people an opportunity to log in so we can get going momentarily. Okay, Bill, I think we're going to get going. I think we've been patient. We're almost 5 minutes in. Thanks everyone again for joining us this morning. We realize everyone is very busy. We appreciate the opportunity to spend an hour with you. Our latest webinar in a series of webinars that Bill and I have put together, we're going to talk about the PPP program and what's next. You know, as all of us are aware, the program, the initial phase of the program was quickly overwhelmed with applications, and the money allocated by the CARES Act has been accounted for and now being distributed to all of those who are lucky enough to get their applications approved. We obviously are dealing now with a second wave of PPP funding that's been announced yesterday, and so now we have two issues. One where people are still applying and have questions on the application process. We've had a couple of webinars to help people through that. But now we have a number of our clients and other contacts that are asking a lot of questions on what do we do now that we've gotten the money? How do we track our expenditures? How do we ensure that we're going to be in the best position to get forgiveness on the amounts that we've received? And that's what we're going to do our best today to try to answer. So again, my name is Frank Milone. I'm one of the founding partners of FML. FML is a full service accounting firm. We're headquartered in Glastonbury. We have an office, fully staffed office out in Enfield, Connecticut, and we also have satellite offices throughout the state, including New Haven and Stamford. We are obviously, we have our own webpage dedicated to the COVID issues that we're all facing as a state and as a country and as business owners. So please go to our website. We're constantly giving out information and analysis, and this is another one of those areas that we continue to evaluate. Today, we're going to, Bill Claffey is going to do most of the presenting today. Bill will introduce himself momentarily. And again, please ask your questions. And at the end of the webinar, if you have any further questions or if you need any assistance, don't hesitate to reach out to us. So with that, I will move into presenting Bill Claffey over to the group. And with that, Bill, I'll let you take it over, okay?
Great. Thanks, Frank. Hello, folks. We scheduled this webinar. We started talking about the webinar even early last week. And we were thinking about whether to schedule it for Friday of last week, Monday of this week. We set in on Wednesday, really hoping that there would be more SBA guidance that would have been issued. I checked early this morning, haven't had a chance to check since about 8 o'clock, but I didn't see any new guidance that was issued by the SBA. So we're still kind of in a world of some uncertainty. We're going to do our best here to try and get to some answers and get to some resolution, and or at the very least, give you guys kind of what we think, in our opinion, might be on some of the items, understanding that, guidance has to be forthcoming at some point. But just a quick introduction. As Frank said, I'm a partner at FML. I'm on the tax side. And specifically, I do a lot of specialty tax projects. I do a lot of state and local work, a lot of credits and incentives work, working with our other federal tax partners. I'm an attorney by trade, so I focus a lot on tax policy, tax controversy items. And so when we started putting together our task force on COVID, which was, probably in early March, it was a natural fit for myself to be involved. And we've been, as Frank mentioned, we've been trying to get as much guidance up on our website as we can, and updating it when we see new issues arise or new guidance come out. So with that, we'll start in. So the first slide here, the first couple slides here, I wanted to just get some general statistics out there. I know a lot of folks have already applied, may have already received money, and then other folks were somewhat boxed out. But as you can see here, the initial program was $350 billion. That started officially. It was passed on March 27th, but they started accepting applications in early April 3rd, and by April 16th, the program was completely exhausted. In fact, I was on a call with a client probably around 12 o'clock on that afternoon, and hadn't seen that it had been fully exhausted. And so we went to the website. Everything is moving very quickly. So that it's been exhausted. As many of you folks know, if you're following the news on this, the Senate approved another, I think it's 310 or 320 billion to go into the program. We're awaiting guidance on whether there's going to be any rule changes related to the PPP program. But that's kind of where we stand as of now. Just some general stats here. There's as of this date actually precedes a little bit before April 16th, but there was 1,000,006 applications. The average loan application, and this is on the next slide, but was 239,000. If that means anything to any of you folks, and you've got almost 5,000 banks involved here. When we look at the next slide, so these are just some stats, and the reason I wanted to bring this up, and so this is as of 4/13. That's why some of those other stats are a little dated, but so this is as of 4/13. The approved funds were 247 billion, and within 3 days there was another 100 billion that was approved. But what I want to highlight here, and it's going to be part of our next couple slides, next discussion, is that when you look at the breakout of who's getting these loans, what stuck out to me was the second item, the professional, scientific, and technical services, and then the finance and insurance, down about 10 spots. That accounts for 38 billion as out of 247 billion, as well as some of these other industries. I guess when I first saw this slide, I would have thought that retail, trade, and certainly the accommodation and food service would have been at the top of the list, but it's not. And so what that leads me to think of as someone who does a lot of tax controversy work and other controversy work is that this program, which if President Trump signs it, signs the new legislation today, there's no reason to think he won't. You've got almost $700 billion of money in the economy. And I think it's going to be very heavily audited, especially considering some of these statistics and whether companies really needed the money. Certainly there was a lot of uncertainty when folks applied for the loan. Okay, moving on. We've got, again, I wanted to present this just so that you understand. You've submitted your application. You may have done it under a certain set of standards that the SBA had issued as of a certain date. Then they came out with some guidance and that changed some of the standards. So for example, independent contractors were somewhat of an uncertainty. Could the business include independent contractors in their payroll costs? I would say there was uncertainty up through April 7th. That changed significantly, changed drastically on April 7th when the SBA issued guidance clearly stating that you can't include independent contractors in your payroll costs. But they also said that if you were utilizing if you had applied and your loan had gotten to the bank and was being processed using the old guidance, then you can rely on that and weren't required to go back and amend your application. Where does that bring us when we get to loan forgiveness? I think that's still a little bit of uncertainty. I would assume that if you were approved for a loan under that standard, then you can apply those standards as you're going through your forgiveness calculation. But I wanted to kind of put forth here, understanding what the banks, what their kind of role in this, what their skin in the game is with this. But in terms of the approval process, a number of folks had good experiences, some had bad experiences. Some had presented loan applications on a Tuesday and got an approval by Thursday, and that bank was going through thousands of applications. So I don't know how much diligence they put into the approval process, but this is what they were required to do. They had to confirm receipt of the borrower certifications. So those are those certifications that the money is necessary and that you're going to use it to retain payroll and that you didn't apply for another PPP loan. They have to confirm receipt of the information that you had employees. That was one of the standards. You had to have employees by February 15th. And they had to confirm the dollar amount for payroll costs. But I note here that they were not required to replicate your calculations. They weren't required to go back and do any additional calculations. They could basically rely on what you presented, which is why I think for some folks, and probably not everybody in our audience thinks it was such a smooth process, but some folks had, like I said, had applications approved in a very short window. And so that was because the bank didn't have to do their traditional diligence they would do on a normal loan. And they were not required to make an independent determination regarding affiliation rules. Most folks, we got past that, and that's not going to be a focus of today's discussion. But moving on, so now we've got the bank obligations for forgiveness. And so I've noted them there. They do not need to conduct a verification of the loan forgiveness calculations. What they do need to review is the documentation that you provide. And that's probably going to be a kind of a check the box. Is the documentation there? Check the box. Yes, it is. Are the 941s there? Yes, they are. Is there payroll processor records here? Yes, they are. And then if the borrower attests that they accurately verified the payments for eligible costs, that's all the bank really has to do. They're specifically held harmless if they rely on those two provisions. In fact, the SBA, and so specifically the SBA is prohibited from taking enforcement action or imposing penalties on the lender who has received that attestation and the documents are there. So why are we sharing this information? I kind of noted it earlier, but because they're held harmless, they don't have a lot of, like I said, they don't have a lot of skin in the game in terms of that forgiveness calculation. The borrower, on the other hand, doesn't have that, does have skin in the game. And so we think that this is going to be subject to some pretty significant scrutiny going forward, if not from the banks, because the banks only have a 60-day window from the date that you submit your loan forgiveness request to give you an answer. And they may be going through thousands of these things in that 60-day window. I mean, everybody's kind of going to get their funds, at least for round one, within a 2-week period, let's say. So they've got kind of an 8-week period where they're going to be trying, 8-week period where they're going to be trying to get all these loan forgiveness requests approved. And so relying on that attestation and just the documentation, they're not going to have enough time to go through the calculations in detail. So I think the SBA and the Treasury Department are at some point going to go through those calculations in more detail. And you have to make sure that you've got everything buttoned up to a T. There's a lot of moving parts here that we're going to get into. And if you either misstate something or you don't kind of keep in mind some of the key dates we're going to talk about, you can really get dinged here on the loan forgiveness piece. Okay, so what I did here is we just listed out the key steps. So now you've got your loan approved. And so these are the things that we want our clients to think about. These are the things that we're thinking about as a loan applicant ourselves, is understanding the law. Frank and I have gone through the law in our previous webinars, but there's a lot of details. We probably skimmed over some of those as we were going through, tried to get into as much detail as we can, but we were covering a lot of different topics. We're covering the PPP, the paid leave, some of the tax provisions. There's a lot of critical items in the CARES Act and in the guidance that's come out since that I call them pressure points. They can trigger various treatments in your loan forgiveness calculation. So understanding that, we're going to go through that in some pretty good detail here following this slide. And I make a statement there, stay up to date on the ever-changing regulations. So the CARES Act is drafted, was drafted in a certain way. The SBA has regulatory guidance. They've already used that regulatory guidance to effectively change what the CARES Act says. And I think that's really important. I spend a lot of my time with the Internal Revenue Code, state revenue code, taxation codes, and the regulations. And I always view regulatory authority and regulations to be interpreting a statute, a code section, et cetera. And so the SBA they've interpreted some provisions, but they've actually changed other provisions. For example, the CARES Act when you did your loan application, the CARES Act required you to look back 12 months to get your average monthly payroll costs. Well, the SBA came out and said, well, we're going to allow you to use 2019 or the last 12 months. I see that as a definitive change in the law. But that's kind of the standards that we're operating in this time and with the urgency that this has to get out to folks and has to be processed. So understanding that, like I said, we're on top of it. I checked 3 or 4 times. Frank's on Twitter. He's got all of his feeds coming in. You may have a change here that comes up in the next 8 weeks that you have to be aware of as you're going through and planning your business, your spend, your use of the PPP loan proceeds. And if you're not up to date on that, could we just go back to the last one there, Frank? If you're not up to date on that, then you could have an issue with the way you present your calculation. The bank may okay it because they're relying on your attestation. But again, I think the SBA is going to come back at some point and they're going to audit these pretty hard. Understanding timing, we'll get into that. There's some key dates that you have to be aware of. You also have to be aware of your individual fact pattern. We've gotten a lot of questions in the last few weeks, or last couple of weeks, I should say, regarding, specific fact patterns, and everyone's changing. Everyone's got a different fact pattern, and it's just applying your facts to your facts as they're given as they are today. What are your facts going to be in 2 weeks? What are they going to be in a month? And where are they going to be in 8 weeks? Understanding that is critical to your ability to strategize and model this PPP process out. Documentation, we'll talk about that. Obviously, that's going to be a critical piece of this. Understanding, what to document, how to document your loan forgiveness calculation is critical. Doing the loan forgiveness calculation itself, creating an audit-proof submission. Frank, I don't know if you want to comment on that. Just, I know you've got more experience with bank audits and those types of matters, but the type of documentation and kind of creating that audit-proof submission. I don't know if you have any feedback on that.
Yeah, I think, hey, Bill, you may want to mute yourself, getting a little feedback, but I think at the end of the day, Bill, this becomes a process of documentation. I know I've been doing my best to try to answer questions as you're talking, and one of them relates to, how to document payroll amounts that are going to be partially funded out of a PPP loan proceeds that are in a segregated account, and part of the payroll is going to be funded out of another operating account because of obviously limitations on the amount of payroll in the calculation for the PPP. And I think there's just, as we spoke about with some of our clients yesterday, this comes down to documentation. So I don't know if there's an answer to the question that's better or worse. Do you fund payroll out of both accounts, or do you transfer the amount out of one segregated account into another segregated account and then go through a process of paying payroll? I don't think there's a better answer. I think it's a matter of documenting it in a manner that you can support whether it's 8 to 10 weeks out, someone asks for support, or whether it's 3 to 4 or 6 months out when the SBA gets around to maybe auditing these things individually, being able to prove in a package, having documentation readily available that you can hand somebody so you're not going back and having to recreate the wheel. So our recommendation is going to be document it in a detailed fashion. And the other thing that we talked about, Bill, was understanding that there's so many questions on how to deal with some of the timing issues on when funds were received versus when payroll hit your account, making sure you're doing the documentation in a way that you can easily change that documentation to comply with regulations as they come out regarding the forgiveness calculations and how it should be maybe calculated in more clarity by the SBA.
Great, thanks, Frank. I apologize for any feedback while I'm talking here. Bad timing. My neighbors, landscapers are doing my neighbor's lawn, so I'm in the farthest room from that. But hopefully the sound isn't too significant. Okay, all right. Understanding the law. Okay, so as most of you guys know, but I just wanted to reiterate, you've got your PPP loan. You applied. You did your monthly payroll calculation, 2.5 times that, you get to an amount. Now you got to use the money. So you've got your payroll costs, and we've talked about that on previous webinars. That's your compensation capped at 100 grand, right? So you're probably gonna have several folks making over 100 grand. Well, you can use the PPP only to fund 100 grand, 100,000 of that on an annualized basis. There was a question earlier about utilizing, can you pay up to 100 grand during the 8-week period? And that's, I think if I understood the question right, that's not, you have to prorate it. So you're looking at someone making $100,000, that's $15,384 during an 8-week period. Plus your employer, the employer funded healthcare, their retirement matches on the employer side, and then the state and local taxes. That's all of your payroll costs that you can use these funds for. Now you can use these funds for greater than an 8-week period, obviously, but you're only going to get forgiveness on that 8-week period. So just be understanding of that. So then you've got your rent and lease payments for real and tangible property as long as the rental agreement was in place by February 15th of 2020. So there's some folks, I think everyone kind of, when the guidance came out, or when the statute came out, thinking, okay, that's just rent on my building. but the guidance goes beyond that. It's rent on any real or tangible property. So you could have some rental costs related to vehicles or some other items that are that may be eligible, may be an eligible use. And I made a comment here. There's nothing in the CARES Act or in the guidance that would prohibit you from not including a related party rental payment, right? So we have that fact pattern with a lot of our clients. They've got, multiple entities. They've got a real estate entity, and so the operating entity is paying rent to the real estate entity. There's nothing yet that would prohibit that rental payment from being included as an eligible use. Utility payments, again, the agreement has to be in place by February 15th. Just note that utilities include the items I've noted there. So you've got your electricity, your normal building utilities, but you've also got telephone and internet access. I know that can be a fairly substantial cost for some folks. On telephone, we're looking at cell phone reimbursements for members of your business. Internet access, obviously, being internet access for your employees, and then mortgage interest payments during that 8-week period. The question had come up earlier: can we prepay any of these items? My comment on that would be unlikely. The PPP program was put in place to maintain and to retain payroll and maintain operations. So I believe that they will look at any kind of prepayment as going beyond that threshold. So I wouldn't get in that habit. Okay, then you've got two other uses here, and I put them in red here because they are eligible uses, but they're not eligible for forgiveness. So you can spend the money on those, but they're not going to go into your forgiveness calculation. Okay, so just going into a little bit more detailed dive here on your payroll costs. So we talked about the salary, wage, commission, similar compensation. I included here that includes self-employment income of general active partners up to $100,000. So that was I would say an issue that had been pretty heavily debated, and there was some uncertainty as well. What do you do? You're a partnership. You've got 3 partners. There was kind of one side of the fence was saying, well, all those partners need to file that doesn't go into your payroll costs, and if it doesn't go into your payroll costs, it's not going to go into your forgivable payroll costs. And they were saying, well, all your partners need to file a separate, and you're an employer in this case, a separate PPP application. And then there was the other side saying, well, no, I think I would deem that compensation, guaranteed payments and so forth, as other similar compensation that's provided in the CARES Act. Ultimately, the guidance landed on that side. So if you are a general partner, you can include that up to $100,000. All of these numbers I'm going to say are annualized. So just I don't want that to be mistaken for you. You can spend up to $100,000. It's all annual on an annualized basis. Okay, so kind of going down the list here, we talked about these other items.
Hey, Bill.
Yeah.
Hey, questions have come up. Can we include bonus amounts paid during this 8-week period? And then the other question was, there's been a lot of questions on 1099ers being included or not included, and I've tried my best to answer some of those questions. As far as bonus payments, Bill, I believe if those bonus payments are paid within the 10 weeks and obviously getting into the 100K limitation, you would include those, yes or no? Am I mistaken there?
Yeah, so that kind of goes into, I think, one of our next couple slides here on the accrual versus a cash type basis.
Yep.
So when you look at the language, it allows you to include the sum of amounts incurred or payments made for payroll costs, and then the rent, utilities, et cetera. Based on my read of that, and based on some other editorial reads I've seen from some firms that I like to follow on this, I think that you can. My opinion is that you can include it. And the guide, again, there may be SBA guidance that comes out that says, differently, or confirms that treatment, or doesn't address it. But based on that read, it's amounts incurred during that 8-week period or amounts paid during that that we compared, especially with regard to compensation. I'm going to get into a little bit.
Yeah, that's fine. And I don't mean to jump ahead.
The nuance between rent and utilities versus payroll. But
yeah, the other question on 1099, and again, I've tried to make this point clear in some of the responses. There was a lot of confusion. If you're a business and you're not self-employed, if you're a business and you included 1099 independent contractors in your payroll calculation,
yep.
Then obviously I believe there's going to be some confusion as to whether you can include those in the forgiveness. And the reason there's confusion is because the SBA guidance came out, midway through the application process that clearly stated businesses that are paying 1099 or independent contractors to a 1099 process should not include those as part of their payroll cost, because those 1099 independent contractors can apply on their own. But obviously now there's been a lot of companies that have included those sort of payments in their average monthly payroll and were approved for PPP applications. So the SBA guidance is talking through a lot of this and saying that, listen, if you applied by interpreting the rules one way and we came out with interpretive guidance, you didn't have to go back and restate your amounts, but they never addressed how those future amounts would be dictated under forgiveness. So understanding there's a lot of questions in regards to whether you include or don't include these 1099 payments, it really does come down to facts and circumstances on your original application. And then also, what we believe is if you've included them in your original application, we believe you should be including them in your forgiveness calc. But again, that's just logic dictating that. There's no guidance right now because clearly the SBA guidance that came out subsequent was you shouldn't have included them in your original calculation of monthly payroll costs in the first place. Go ahead, Bill. Sorry.
Yeah. I mean, I completely agree with what you said there, Frank. And that's kind of there's a lot of $1 million questions, but that's one of them. If you've attended any of the prior webinars, I've told the story of a client that only had independent contractors and applied on April 6th with those independent contractors and his payroll numbers. And then the guidance came out on the 7th, or maybe he applied in the morning of the 7th and the guidance came out on the evening of the 7th. And so his loan was approved for only those costs, didn't have any employee costs, only independent contractor costs. And so as his business goes through the forgiveness phase, let's call it, I believe you can go back to the CARES Act, and even you use the CARES Act as part of your support that independent contractors should have been included under the CARES Act anyway. So with the fact that he was approved under the previous guidance, and the fact that the guidance tells you that if you applied, you didn't have, using prior guidance or guidance up through that date, that you didn't have to go back and amend your return. I agree with you, Frank. I expect that to be addressed in future SBA guidance, but I don't know if that'll get addressed. Okay, I had a question. So the owner's benefit. So a lot of folks that were looking at their general partners were, if they had a provision in their partnership agreement where they were, matching, retirement benefits, or they were providing any kind of health care, employer-funded health care, could they include that? There was some guidance that came out with, it was mainly related to sole proprietors, but certainly indicated that the partner compensation would be capped at partner payroll costs. Let me not say compensation. Partner payroll costs would be capped at $100,000. So therefore, if the business was paying insurance, health insurance premiums, that couldn't add to your $100,000 cap for a general partner. Again, it's a timing issue. If you had applied prior to that guidance coming out, and that was one of the later rounds of guidance, I believe you probably could include those in your forgivable payroll costs. But we'll see where that lands. But the new guidance basically says you can't if you're a general partner. Okay, I think we can go on to the next slide. Okay, so then I put in here forgivable costs for sole proprietor independent contractors. Again, this guidance came out kind of after the fact. Some folks had already applied, but if you were sole proprietor, they're really looking at your net profit from your 2019 tax return for your owner compensation replacement. So if you've got employees, right, you can those costs count for loan forgiveness, qualify for loan forgiveness, no different than another type of employer. But as sole proprietor, they're looking at owner compensation replacement, and they're going to look at they require that you provide your 2019 tax return. Got a lot of questions on, well, I didn't file my 2019 tax return because it was extended to July 15th. They are requiring it. I think you can submit a draft of that and use that as your basis. But that's how they're going to do. That's how they're going to do the calculation with regard to.
Yeah, Bill, I've heard drafts have been submitted and accepted by banks. I think this is a common question we're getting by sole proprietors and independent contractors. There's obviously some guidance that came out in relation to how sole proprietors and independent contractors should apply. We'll get into some of that, but I would remind people that we've written something up on that and submitted it on our website for review. Knowing that a lot of independent contractors unfortunately got boxed out of the first round of PPP, and they're going to be going through a process of applying, I would assume, as part of the second round.
Okay, I think we can go to the next slide. Okay, so this slide gets into the point that you brought up about 10 minutes ago, Frank. So forgiveness calculated only on the sum of amounts incurred and payments made during the 8-week period following the date of loan origination, which was there was further guidance from the SBA saying first disbursement. So we talked to a lot of clients about the funds. There seems to have been an approval date and then a disbursement date, and those typically pretty close together. Approval date from the SBA, getting an SBA document number, but that's when they're going to start running this. That's when they're going to start running the math on the amounts that you're incurring and payments made during an 8-week period. So as I state there in the second bullet, reading the CARES Act and reading that language, you can make an argument that if you incur the cost but pay it at a date later than at a later date that falls within your 8-week window, that would be included, and vice versa. I do make a statement here about so when the CARES Act goes through forgivable costs, they use the term payroll costs, and then kind of next bullet down they say payments for rent, payments for utilities, payments for mortgage interest. That does indicate that they may be looking to treat those differently. And again, this is where the SBA should be providing interpretative guidance rather than changing the law. But if you read that, you would say, okay, for payroll costs, it can be incurred or paid during that 8-week period. And that's critical. And frankly, we can kind of talk about a fact pattern we had discussed with a client last night where I think their loan approval was on the fund disbursement was on the 14th of April.
Correct.
And their payroll run was on April 16th.
Correct.
If I remember the facts correctly.
Yeah, and I think we debated with them, depending on how much of that payroll being paid was actually included in the period from funding, which was the 14th forward. So there was a lot of debate as to whether you include, let's assume, 1 day or 2 days worth of payroll cost, or do you include the entire amount because it was paid subsequent to the funding date of the April 14th. We had probably a 20-minute conversation alone on that and just debating whether they should do an allocation, include the entire amount, or look kind of 8 weeks out, depending on their payroll, right, and when payroll was paid, to make sure that they were going to get 8 weeks into the payroll cycle, 8 weeks of payroll into the 8-week period of measurement. And ultimately, I think we decided to take the approach to include it all, but document it in a way that when the SBA guidance comes out, which we anticipate is going to come out hopefully soon, they have the ability to adjust their documentation to hopefully comply with what the SBA gives in the form of guidance.
Yeah, that was the base of the conversation. I think it's protecting yourself now in anticipation of the guidance, being flexible. And that's going to be that's going to be something that we're going to talk about throughout the rest of this webinar. And you need to think about, for the next 8 weeks, if you've already received your funds. And so flexibility. Okay. I think we can go to the next slide there, Frank. Okay. So understand the loss. Now we get into the forgiveness calculation, and it gets a little muddy, but we're going to do our best to get through it. So, and I've got on a later slide here, kind of just a step-by-step process. But basically, you start with you were approved for a loan of $100,000, right? And that was based on 2.5 times your monthly payroll cost. But you got $100,000 that's out there. Now you've got this 8-week period, and just the way that I'm reading it is it's 8 weeks. And so we had this conversation yesterday as well, Frank. You may say, okay, we got it on April 14th, so we've got until May 14th to make sure we use these PPP proceeds. Well, I would recommend that if you got on April 14th and April 14th was a Tuesday, that you count 8 Tuesdays outward versus looking at the 14th, because there's an extra day, right? There's an extra day in May that's gonna, and so you don't look at dates, look at weeks, at least for the time being. So you've got this 8-week period that you've got to use the proceeds and spend the money. If you spend it on the cost that we discussed on the earlier slide, the forgivable cost, that's your starting point, right? So you had a $100,000 loan, you spent $90,000 of it because your rent and your mortgage interest and your utilities just didn't allow you to spend the full $100,000. And I think that's going to be a somewhat common fact pattern. I mean, if you have a lot of rent and you have a lot of significant utility costs, then you're going to bump up against it a little bit more. But I think for service type businesses that don't have a significant rental payment, I think you're probably going to be a little bit under. But let's say you have the loan for $100,000, you only spend $90,000 during the 8-week period. That's your starting point. Okay, then you've got these various reductions that come into play. Okay, so the first reduction is a reduction in full-time employees, right? So you're going to take a look at you're going to look at your full-time equivalent employees. What was your full-time equivalent employee during that average full-time equivalent employee head count during that 8-week period? So let's say that's 10. That's going to be your numerator. And then your denominators, you're going to get an option to choose. So you can either, again, if we have any folks that are seasonal based businesses, there are some special rules that relate to seasonal businesses, but we're not going to go through in detail today. If you have those questions, shoot them up on the chat line and we'll do our best to answer them. But then your denominator is going to be, you have an option. You can choose one of two options, right? So option A is you look at February 15th to June 30th of 2019. What was your average FTE count during that period, or your FTE equivalent employee count during the January 1st to February 29th, 2020 period. For purposes of full-time equivalent employees, it's not specifically defined in the PPP in the CARES Act, the PPP portion. There is previous SBA guidance that does go through that definition. And basically, it's if you have an employee that works more than 30 hours, then they are considered a full-time equivalent employee. If you have employees that work less than 30 hours, then you basically aggregate their hours worked to equate to full-time equivalent employees. So if you've got 2 employees that are working 15 hours a week, then that would equate to 1 full-time equivalent employee. Again, that's SBA guidance on a different loan product, but I think the concept is going to carry over, right? So you've got this ratio that you're going to calculate based on that numerator and then one of the 2 denominators. Whatever that ratio is, that ratio is going to be applied to the amount that you spent. So in our example, you spent 90 Let's change the math a little bit. You approved for 110, but you spent 100, right? And so your employee count was 9 in the numerator, and your best option in the denominator was 10. You're only going to have 90,000 of that loan that's going to be eligible for forgiveness. We're going to get to the rehire concept, but that's kind of your starting point, right? So that's the reduction in FTEs. Then you've also got you also have a reduction in salary, and I'm looking at these as all being very isolated. So you do one calculation for the reduction in FTE, one calculation for the reduction in salary. So if you have employees that you reduced their salary by more than 25% of what they made in the prior quarter, and again, that the CARES Act and the SBA starts playing around with all these various dates. But if you're looking at the prior quarter, how much did they make during that prior quarter? Well, they made $25,000. They made $20,000. If you reduce that person's salary by more than $5,000 in the 8-week period, so effectively you're actually getting a little bit of a bump up. You can reduce them by more than almost 40%, assuming the facts kind of line up. If you reduce their salary during your 8-week period, as compared to what they were making on February 15th, 2020, then you could have your forgivable portion of the loan could be reduced because of a reduction in salary. And I hate to use the word reduction multiple times, but that's the way it's stated in the CARES Act. Now, important, that only applies to folks that made less than $100,000 in 2019. And so if you have an employee that made over $100,000, again, there may be interpretive guidance that comes out, but the way that it's drafted right now, you had an employee that made $101,000, you can reduce their salary down to $1, and you're not going to get dinged for this reduction in salary on the loan forgiveness calculation. Now, the CARES Act says if you made over $100,000 during any pay period on an annualized basis in 2019, then you're not an employee that this reduction in salary needs to be accounted for.
Hey,
so,
Bill, we've debated this a little bit, right?
Yep.
So that interpretation is they don't count at all. The other interpretation is if you reduce an employee who is making over $100,000, if you reduce their salaries for the amount that they make above $100,000, so if someone makes $150,000, you've only included $100,000 in the calc. If you reduce that person's salary by $50,000 and reduce it down to $100,000, that's what doesn't get included in the calculation. And anything that you reduce for that person below the $100,000 may be included. So I think, and not to confuse people, but that's the other interpretation on how some people are asking those questions as well.
Yeah, and again, Frank, you and I have had this conversation and multiple times. There's logic, which I think everything that you in our calls, it's always there's logic, right? And that makes a ton of sense. However, that's not the way that the act is drafted, at least, and there hasn't been any guidance on this point. That's why, again, all the guidance has come forth with regard to pretty much loan application and maximizing. They've provided some guidance on the forgiveness, really kind of focusing on the third bullet, which we're going to talk about, which is the 75-25% ratio. But they really need to dig in on these concepts and so that people can make informed decisions going forward. Because the way that I read it, and again, we can differ on that, but the way that I read it is that if you have an employee making over $100,000 in 2019, then this whole reduction in salary will not, and you reduce their salary, it's not going to hurt you in terms of your loan forgiveness. Now, the way that the act is drafted, it says makes $100,000 on an annualized basis in any single pay period. So the fact pattern that I can see coming up for folks is I had an employee that made $60,000 but I gave them a bonus, and I gave them a Christmas bonus on December 20th of $5,000. That went into a certain pay period. If you annualize that pay period, that would be more than 100. That, I believe my math is correct. That would be more than $100,000, assuming you're paying them on every twice a month, right? So that employee, even though they made $60,000 and that's kind of their salary, they should be part of the salary reduction calculation. But because they had an annualized amount in 2019 that put them over the threshold, then they potentially that salary reduction would not be considered.
Yeah, I think it's a good point. I just want to, Bill and I do this periodically. It's a 10-minute warning, Bill, till noon. So want to keep that in mind. And then, Bill, will we get to this, the forgiveness being, you can't use more than 25% of the forgiveness on non-payroll related? Because there's been questions on that, and there's been constant confusion that people believe now that you can only use 75% of the amount being forgiven for payroll, where it's not that at all. It's actually, you can only use 25% relating to non-payroll, but you can use 100% of the amount that you've received and apply it to payroll to get it forgiven. We just need to make sure that that's clear.
Yeah, that was and I apologize, I haven't been able to follow the questions that have been coming up, but I will do my best to respond to everybody. We get it downloaded the questions, and but I did see that was an early question that came up, and so that's your third kind of bullet. If you're looking at reduction, you got FTE, you got salary reduction, then you've got the third bullet is this 25% threshold. So what they don't want you doing is getting a loan for $100,000 and spending $100,000 on rent and utilities and not paying payroll. So they cap your non-payroll costs at 25% of the forgivable amount. So for non-payroll costs. So if you had in that scenario, you've got $100,000, you spent $60,000 on payroll, and you spent $40,000 on a combination of rent, utilities, and mortgage interest. Well, you're not 15,000. My math correctly there? Yeah, 15,000 of that is not going to be forgiven because it's over the threshold. You were only allowed to spend $25,000 on non-payroll related costs, and because you went over that threshold, that amount, that difference, that delta, is not going to be forgiven. In your example, Frank, if you got a loan for $100,000 and then you spend $100,000 on payroll costs, there's nothing that would, there's nothing that caps you at 75%. It's going the other way. Now you'd have to have a unique set of facts, I think, kind of especially given our environment, where you'd have $100,000 that you calculated at a 2.5 times multiple, but now you only have a 2 times multiple to spend that money. And the discussion that you and I, Frank, had, and I think we might even had it with a couple of clients, is, well, if you've got a number of employees that are making less than $100,000, so there's some wiggle room there. Could you take that money and use it to increase their salary during that 8-week period to kind of fully spend the $100,000 that you were approved for? So I don't know if you have any comment on that, Frank. I have my comment again goes back to the certification of needing the loan to maintain operations and retain employees. I think, and there's nothing in the CARES Act that says that you would be dinged on that. There's nothing in the guidance to date that says that that's not an option, that's prohibited. But somewhere down the line, could I see the SBA and the Treasury Department coming in and saying, you increased your pay. You didn't need it to maintain. You used those funds to basically pay your employees more money than they were earning prior to this date. And so we're not going to allow that. That's one way of looking at it. Yeah,
I agree. This is one of those murky areas that are going to have to get clarified. I mean, I think increasing payroll costs to employees, I think, is something that can be misunderstood. And it probably can also be based on fact patterns. If someone is, due to a commission plan change that was implemented on January 1st, and now that individual is going to make more money this year versus last year because of a commission plan change or because of a bonus plan that got implemented on January 1st, well before this whole process happens. I think there's a lot of fact patterns that are going to be able to get supported in increasing salaries. Obviously, there's been limitations on salaries includable for forgiveness because of they don't want inappropriate increases going to a certain segment of the population, i.e. executives making over a certain amount, getting PPP proceeds to fund their own bonuses and things like that. So I think this is one of those areas where we're hoping more answers come on the SBA side as well.
I'm looking at my clock. I know we're running long here, but I think it's really important, and I hope folks can appreciate this piece of it. So you've got your 3 areas of reduction, right? FTEs, salary, 25% threshold. Then you've got this whole impact on rehires. So and this goes into our key dates, if your reduction in full-time equivalent employees occurs between February 15th and April 26th, which is 30 days after the act was signed into law, and you had a reduction in full-time equivalent employees during that time frame, and now you're getting dinged on the FTE reduction. The act states that if you had a reduction based on that basis, and you bring an employee back, you increase your full-time equivalent employee. It doesn't have to be the same employee. You just increase your full-time equivalent employee back above your February 15th number, then the way that I see it, that number that whatever that number is goes back into your numerator, and so it eliminates the reduction of the loan forgiveness reduction based on FTE up to whatever ratio you can get, right? So if you brought back, if you lost 3 employees and you're able to bring back 2 by June 30th, then your FTE forgiveness ratio calculation is going to have that increase of those 2 employees, and so your forgiveness ratio is going to be higher, and the forgiveness amount is going to the reduction in forgiveness is going to be less. A lot of questions coming up. Well, does that actually mean that I can bring back an employee on June 30th and then terminate him on July 1st? The answer to that question is yes, as of April 22nd at 11:58 a.m. That's the way it reads. That's the way the CARES Act reads. That's the way, like I said, I've been following some other law firms and such, and that's the way they're interpreting it. Now, the SBA I can't believe that they're going to allow this type of manipulation to occur. So they may come out, and like I said earlier on this webinar, they've come out with regulation that is contradictory to the way the CARES Act is drafted, and I wouldn't be surprised if they tried to put something in there that said, okay, you gotta bring them back by June 30th, but we're going to only include, and this is another point that Frank, you and I talked about, is if you bring them back, do you just bring them back and kind of calculate their full-time equivalency on an average basis? So if you brought them back on June 30th or June 29th, that impact is going to be significantly less. Whereas if you brought them back on May 1st, a week into your loan forgiveness, your 8-week period, the impact is going to be significantly greater.
Yeah, this is all of the questions. I mean, Bill, you and I wanted to put a list of questions at the end of this webinar, because as much as we're doing our best to stay on top of this and to go through scenarios, each time we talk to a client, each time we deal with individual circumstances, we're coming up with more questions. And I think one of the recommendations we're giving to people is, just do your best to research on your own, do your best to stay on top of it, and then obviously use experts like us to help you through the process. I think this is there's no doubt guidance is going to come out on forgiveness, but we're also sensing that if anybody's paying attention right now, there's been some pushback already nationally being given on supposedly companies taking these loans that don't necessarily need it based upon other people's judgments, based upon hindsight, companies being viewed upon why would you apply when the guidance was definitely clear that all you needed to do was certify that there was uncertainty on what your business was going to incur in the next 8 to 10 weeks. And you were applying in good faith because you were using the funds to help you maintain or address some of that uncertainty. All of these things are now being put into light by the media in a way that is unfortunately giving pause for banks to actually start applying this in the second phase. I've read that already today. And I think it really comes down to the fact that we're going to have to use, Bill likes to comment on my logic comment, but I do use logic, but I also use Bill to bring me back into the CARES Act and what it says, because I think there's a balance of, you need to apply logic, but you also need to ensure that you're staying in front of the facts and how the law is written so that you're making your decisions based upon both factors. So we're running over, Bill. I want to continue to move because I appreciate people staying on. We will present as much as we can, understanding people's timelines. So I'm going to move the slide forward and let's keep going.
Okay, so this is we can go through it, go by this one. This is what I talked about. What I look at is kind of a 4-step process. I'll be happy to flush this out for if anyone has any questions on it once they see the slides. But that's okay. That's the step that I would go through if I was doing my loan forgiveness calculation. So now you've got these key dates. Like I said, understanding these and how they impact your business is critical, right? So you've got your denominator date, the February 15th to June 30th. You've got your denominator date, the January 1st, 2020 through February 29th, 2020. Understanding what your count is, I mean, you're going to have to go through that process like sooner rather than later, so that you can understand, what denominator you're going to use. A lot of businesses that use, part-time folks they're not seasonal businesses, but they do have employees kind of coming in and out. Use of interns, clearly, it's something that we have to consider. We've got, heavy periods of intern use. Well, how is that going to impact our calculation? February 15th, 2020, that's a measurement date. So a lot of the reduction criteria that we just discussed kind of harkens back to this February 15th date. So that becomes an important date. April 26th. That's a critical date, because that's when you're looking at the FTE reduction and the salary reduction and the impact of rehires. The way that the act is drafted states that all of that has to occur by April 26th. So if you make a decision on April 27th or April 28th to have a reduction in full-time equivalent employee or a reduction in salary, well, then you just reduced your salary, and the whole potential to kind of get that back with the rehire concept, or the bringing the salaries back up, eliminating the reduction in salary, that doesn't appear to be an option right now.
Yeah, Bill, I think this is critical. I want to reiterate it in a way that, if you have any reduction in FTEs between February 15th and April 26th, under the rules right now, you have the ability to rehire those people back and have them not impact your forgiveness. That's the way I like to say it, without using all sorts of technical CARES language. And then if you have also reduced salaries during that period, you also have the ability, in my estimation, I believe, Bill, to get those salaries back up to levels before June 30th. And allow them not to count against reducing the loan amount that will be forgiven. We right now, if all of those sorts of things happen after April 26th, they will impact your forgiveness, and you do not have any ability to rehire people or reestablish salary levels and have them not impact forgiveness. That's the way I'm reading it.
Yep, and I'm in agreement there, Frank. June 30th, so that's the date that you have to do these things by, right? You have to either hire folks to get your FTE count, or you need to reestablish salaries up to the measurement is actually looking at the measurement when you're looking at reestablishing a salary amount. It's looking back to February 15th. So that's why those dates kind of they interplay, and they come in like different concepts. And Frank and you and I were discussing, we're like, we probably discussed for 45 minutes. Why are they using two different measurement periods here? I don't know. I don't know exactly the logic behind it, but you've got various measurement periods and various dates that are critical. So that June 30th is very critical. If you have a scenario where you lost lost a full-time equivalent employee, and sometimes you may have lost a full-time equivalent employee not because you had to furlough them or terminate them. They left on their own accord, right? They had someone they needed to take care of and they needed to leave. They got another job, and so. Some of those situations are out of our control, but if it does occur during our window here, 2/15 to April 26th, then you've got till June 30th to get that back in line. The disbursement date, we talked about how critical that is. Understanding what your date is, understanding where your payroll hits on these various dates, or your rent payment and your mortgage payment, your mortgage interest. If you've got a date that falls outside of your 8 week window, arguably for some of these, you may not be able to include that in your loan forgiveness calculation. I think we can go to the next one, Frank. Yep. Okay. Okay. So I think we kind of just covered this. When you guys get the slides, so you can kind of look through this, but the concepts that we just discussed. The last bullet there. We talked about earlier, and I would expect guidance on that, the cash versus accrual. Are they going to look at, well, how do you, for purposes of your tax return or for purposes of your financial statement, there may be guidance that comes out that says, hey, if you're an accrual-based taxpayer, then you use accrual rules for the 8-week period. If you're a cash-based taxpayer, then you use cash basis for the 8-week period. I have no clue where they're going to come out on that, but that's something that is certainly, I could see that coming out in the regulatory guidance. The CARES Act doesn't necessarily say that, but I could see that coming out as part of the interpretation. Okay, so now we get on to the planning stage, and I really apologize, folks. We're going over here, but planning. It's again, we talked about it. We kind of touched on these concepts, and so we don't need to spend too much time on them. But you really have to start planning this out, like sooner rather than later, if you haven't already started. Understand what your needs are going to be during the 8-week period. Understand, what your FT account is going to be in the 8-week period. Understand what your revenues are, and you need to start putting this kind of this plan together of how are we going to spend the money and how are we going to
I think this is critical. I don't mean to cut you off. I think the general sense here, everybody we've talked to, is project out your 8-week spend in a manner that's going to allow you to educate yourself on the issues that you're going to need to deal with. You talked about rent payment timing, payroll payment timing. We've talked about even doing it internally, understanding your measurement of FTEs on the denominator, whether you're going to go back and use 2019, whether you're going to go back and use 2020, to be able to react to any issues that you can plan ahead for, and make sure that you're addressing proactively instead of reactively, and managing to those expectations, understanding that you may need to make some choices on when certain payments get made, making sure you're putting yourself in the best position to not manipulate the process, but to make sure that you're making your payments and documenting your process in a way that supports why you should get the amounts forgiven. Really, really important.
Yep, absolutely. And so I've put together our version of, I know there's a number of like loan forgiveness calculator versions out there. I put together one, for FML, the way that I think it captures all the key points in a usable format. But there's a lot of spider webs here, and so you can get turned around pretty easily if you're not aware of all the kind of the pressure points within this program. Understand the facts. We've discussed about this. The last bullet I think is really important. Frank, you touched on it earlier. I just note this because, again, my opinion, and all it is an opinion, is I think that there's going to be some scrutiny here. I think that the SBA and the Department of Treasury are gonna look at this, and I don't know what their timing is. I don't know if it's going to follow your standard, IRS type statute of limitations, or whether there could be a different limitations presented for this program, given the kind of the magnanimity of it. But I think there's going to be, understanding where does your business sit? Did you need the money to retain payroll? Can you look back? And again, this may be an area where I expect there could be additional guidance that would come out to say, okay, when you applied, certainly, I think during the early April, I mean, it's only been 20 days, but it feels like a lifetime in some regards. There was a level of uncertainty then that some businesses may not have. They've kind of gotten through the 3-week period, and other businesses may have gone the other direction, right? And so, understanding kind of where you are and whether those good faith certifications that you put on the loan application are still relevant is critical, and understanding all these other factors are very important. Okay, well, next slide here. So I just put in a couple other things to keep in mind as you're going through this, understanding your facts. So one question that one of our tax partners, Lisa, and I talked about, and Frank talked about, is understanding some of the credit impacts. So if any of you folks are out there and you're taking R&D credits, well, if you're having if you work with us, you know that if you have funded research, that's not considered a creditable expense. And some folks are taking those credits and using it to offset payroll taxes. So it's even if they don't have income in 2020, it can be kind of an immediate cash benefit. But the concept came up of, well, what if we have if the loan is forgiven and we use the loan proceeds to pay people that were doing research during the 8-week period, is that going to be a quote unquote funded cost and therefore not eligible for the credit? Again, could be a very important decision making concept for some folks that are getting sizable credits and they're getting kind of an immediate benefit for them. Right now, I haven't seen anything from the IRS on it. My thought is that I think you can get around that, because under the funded concepts, the taxpayer is at risk at the outset of the contract, right? So if we looked at this as a contract, I could make the argument that there's some risk there, that you're not going to have the loan forgiven, et cetera. So again, we'll wait to see where some guidance is on that. Can you just go back to that last slide there, Frank? I just want to touch high level on this. The worker retention credit, paid leave. If you got an SBA loan, you can't take the worker retention credit. Tax deferrals, right? So this question came up this morning from another client. There was some uncertainty here. So if you applied for a PPP loan but also wanted to defer your payroll taxes, which is a part of another portion of the CARES Act, there was some uncertainty as well. If you're going to have the loan you specifically can't have the loan forgiven and take advantage of the deferral. The IRS came out with some guidance last week, clearly stating that you can get your PPP loan, right? You get your disbursement on April 22nd. You've got the 8-week period, then you've got 60 days to get a forgiveness letter. You can defer your taxes from the date, the date that you chose deferral, up until that date you get a letter from the bank saying that your loan has been forgiven, and it's any portion of your loan. And then those deferred taxes then would get paid just like anybody else that's not doing a PPP loan. 50% of it would get paid on December 31st of 2021, and the remaining 50% paid on December 31st of 2022. Again, there was some uncertainty there, but the IRS cleared that up. The other approach would have been, well, you can't defer if you're going to loan forgive, or you got to pay it back. You have to pay it back when you get your loan forgiveness letter, and so they've cleared that up for us. You can't defer after you get your loan forgiveness. State income tax and forgiveness. This is a pretty critical point for folks that are, maybe doing okay they're doing okay, and they have the loan forgiveness. It's not taxable from a federal tax perspective, but the states haven't. There's a couple of states that have addressed this. I saw Wisconsin came out with something earlier. I haven't seen anything from Connecticut, but that loan forgiveness amount may be subject to tax in the states if they don't, it's going to depend on how their conformity dates with the IRS or the Internal Revenue Code and so forth. But just understand that as you're mapping this out, you may have like an 8% bleed on this because you're going to owe some state tax on it. Effective tax rate, taxable to partners, members. If you're a partnership and it goes through, Lisa and I talked about this a little bit earlier. How does that go through to the K1? And our belief is that it's not going to be taxable at the entity level. If you're a corp, it's not going to be taxable at the partnership level for federal income tax purposes only. And then it would be a separately stated item that would be not taxable to the members. And then I don't know if you want to touch on timing. Do you want to touch on that, Frank? The financial statements. Timing?
Yeah, I think there's been some questions on timing. I mean, so for 6/30 year ends, you may be in a position where you're going to apply for forgiveness subsequent to your financial statement, your fiscal year end. And if you do not get approval for forgiveness before the financial statements are released, the question has come up, can you forgive, or can you take the forgiveness within the financial statements for the year ending or the period ending June 30th of 2020? We're currently evaluating it. I think the initial position is this is going to be a subsequent event, has to be evaluated under type 1, type 2. And then ultimately, we believe until forgiveness is given, you can't do anything on the loan. That needs to be basically shown as a liability. And if you do get a subsequent event, a notification of forgiveness before the financial statements are released, the question becomes, can you apply that back to June 30th? We're hoping to have that answer within the next day or so, but as of this date, it clearly is a subsequent event evaluation.
And so we list, I'm not going to go through all this, but we've listed, as Frank mentioned earlier, document. This is a list of the various documents that you're going to be required to provide. And so as you're going through your process, I would just make sure that you are documenting everything to the penny, because I think it's going to be heavily scrutinized. Anyway, I apologize for going long, folks. I know I hope we addressed a lot of the issues that you guys were thinking about. I'm sure we missed some, and hopefully those came up in the questions. And I'll go through the questions tonight, and I'll try and get responses out, and that'll be published as part of our slide deck.
Yeah, Bill, thanks so much. We still have 86 people. I think we got up to about 120 or so, but still have 86 people here that are still listening in. So obviously, we will do our best to get the slides out today. That it's been a common question that I'm seeing coming through. One of the specific questions, Bill, that I think kind of verifies one of the major points. Someone asked a question, if they had a $100,000 loan, they paid $25,000 of non-payroll related expenses. So there's your 25%. And then they only use $65,000 of the $75,000 of payroll related costs. What does that mean for forgiveness? My answer was, if you've only used 65 of the 75 in payroll related expenses, you're not going to get 10,000 forgiven. You're going to have to basically pay that 10,000 back that you didn't use for payroll related costs. You agree with that, Bill?
Yeah, you're going to have, so the way that I set up the calculator that I put together is, you're going to have this out, you're going to have this money that's unspent money. There's no prepayment penalty, so you can just prepay that back to the bank with no penalty, understanding that you're going to have the 1% interest accrual for 8 weeks. Or you could take that unspent proceeds and use that for eligible uses going forward, and just knowing that you have to pay back the loan within 2 years.
Yep. Yeah, the other question, Bill, and again, we'll go through this. People obviously are going to be dropping off. A couple of things that maybe we can address. The 100K cap is only applied to the wages paid and not to the all-in payroll costs, wages and benefits for that employee, ? Yep. 100% of the benefits can be included in the forgivable amount, ?
Yeah, correct. Yes, they can. They all get summed into payroll costs. There's a little bit of uncertainty as to whether general partners So you've got a partnership that has 3 partners and 10 employees, right? For the 10 employees, absolutely, they can go in. Now, can you go in and, let's say your typical, your healthcare funding for your employees was $1,000. Can you up that to try and maximize this? I think you start to run outside the parameters of retain and maintain operations that may be deemed to be excessive, but certainly, let me go back to the core question. For employees, clearly that all those costs can go up and above $100,000, assuming you're not, abusing what was previously spent. And then for general partners, right now, I'd say if you got your application in before the new guidance came out, I would say you probably can include like healthcare premiums and stuff like that as part of your forgiveness. If you got it out after, and I don't have the date, whenever that sole proprietor guidance came out.
Yeah, it was late, and
it was late. Yeah,
it was late, and it clearly said that owner benefits should not be included.
Yeah, owner kind of gets capped at $100,000 all in, versus employees only have the compensation piece and capped at $100,000.
Yeah, I mean, there's a question on whether they should open a separate account to hold the funds. I mean, we have addressed this in one of our slides. I think our best practice is yes. Is it required under any of the law? No. We believe that having it separated will just help in the documentation of your usage and being able to transfer monies out of that separate account in a way that can get documented by backup on payroll or other uses makes it a much more auditable process and traceable process in that regard. There's a lot of very specific questions in relation to what sort of fees can and cannot be included. There's also been a lot of questions in Bill and what we've been dealing with, which is, hey, what happens if we applied this way and now we're spending the money differently because we've been told that we can do this or cannot do this? And we believe that there needs to be guidance given by the SBA in that regard. We're just not in a position to give you our definitive answer other than to say, I think the answers I've been given is be consistent. To your example, Bill, if you had a client that gave nothing but 1099 payroll in as the application amount, we would expect that they should be able to use that amount in getting forgiveness. But I can see the SBA coming out and saying, listen, we allowed you to take the loan, but if the 1099s that you're paying also applied for PPP proceeds, we will not allow you to forgive those amounts being paid. I can see very specific guidance coming out in that regard later on. So document, and make sure that you're in a position for those points that may be under debate to ultimately have to pay back certain amounts that you're paying in that regard. Just be aware of that. So, Bill, I think, we're at 12:22. Again, I think, so the last question, I think it's a couple last questions, Bill. Can the unforgiven portion be used for any cost since it's required to be paid back over 2 years? I don't see why not. If you're going to pay the money back, if you're not going to use the unused proceeds to offset the payback of the loan, if you use them, just be understanding that you're going to be paying it back over a 2-year period with a 1% interest rate.
Right now, so the slide that we had on eligible uses, I had two uses in red. My thought, Frank, on that is that you can expand, you can use it, you can always use it, whether it's in the 8-week period or not, for those amounts, those items I put in red there. My opinion on this is that, no, I don't think you can take a PPP loan, spend 75% of it, have a 25%, that is not going to get forgiven anyway, and then go use that and buy some, fixed capital or give yourself a huge bonus. I think that
there's going to be guidance that comes out on that too, Bill. I agree with you. I think they're going to want that money back into the system sooner than later, right?
And the reason I say that is that the eligible uses are definitively defined, and so it's only those six or seven bullets there I put on that slide.
Yep.
So I think once you go outside that scope, you're now you're misusing the PPP funds, and they have programs that are if you need funds for other items, I think the SBA would say, well, then go get an EIDL loan.
Yep. Last question, Bill. Are you certain that 401k match doesn't have to be factored down for employees who are making more than 100K? We're pretty comfortable, right? That got added back into payroll, right?
Yeah.
Yeah, I mean, that came out, that was clarified at some point in the SBA guidance, I believe.
Yeah, so like I said, we'll get a download of the questions. I'll respond to all of them, but I'll respond to that one with the citation if just so that makes you more comfortable. But again, as of today, right? So we're sitting here at 12:25. Guidance could have came out in the last hour and a half. But yeah, that's the way that it reads. That's the way the guidance reads. Again, as long as you're not abusing it. So you can't go, I think if you had typically matched at a certain rate and then you said, I'm gonna maximize that now because I want to take advantage of forgiveness, you could get yourself into an issue there. Yeah. Because you're not maintaining and retaining your expense.
And again, a lot of people asking questions on the dates, key dates. Listen, what I will tell people is, please reach out and seek guidance on the dates. I mean, I can't, the April 26th date is the date that we're taking out of the CARES Act. It basically means that if you have any change in your employee base, FTE count, from February 15th to April 26th of 2020, or if you have any salary adjustments that were given to your employees during that period, it ending on April 26th, and I believe that date is critical because it is clearly outlined in the CARES Act. That measurement period is then allowing you to reinstate FTEs or reinstate employee salary levels and not have them get taken against the calculation for forgiveness at some point in time. If you have personnel changes after April 26th, will it impact forgiveness? At the way the act is currently written, yes, it will. And even if you bring those employee levels back, will it impact forgiveness? It may. And the way we're understanding it right now is it probably will. So
right. It basically, the way that it reads right now, it basically prohibits you from taking advantage of the rehire concept.
Yep. And then, and again, people are still fuzzy on, whether you have to pay the cost in the 8 weeks or incur during the 8 weeks. It's a great question. We're fuzzy on it too. We're telling people to document how they're approaching the forgiveness calc based on incurred versus paid and be doing it in a manner that allows you for some adjustments. We're also asking people to project out 8 weeks to make sure that they're doing it consistently on the front end. If you're basing it on incurred or paid, basing it consistently on the front end of the 8 weeks and the end of the 8 week period, depending on the timing of your cash payments and your payroll cost. That's the best advice we can give you at this point in time. So with that, I think we're going to sign off. Thank you so much, Bill. A lot of effort goes into these webinars. Bill has been working tirelessly. A lot of people on our COVID committee have been, but no more than Bill. So thank you, Bill, for all the effort. Thank you, everyone, for participating. We will do our best to get all your questions out, answers out to your questions, the slide deck. We also are recording this, so we'll do our best to get the recording available to people who have enough time on their hands to want to listen to us again. And at that point in time, again, please don't hesitate to reach out if you need any assistance whatsoever in your process going forward. And thanks again for all your attentiveness. Have a great day, everyone. Bye now.